Hi friends, when it comes to businesses like Swiggy and Zomato, there are two types of investors. Type 1 is those investors who are extremely bullish on the quick delivery, food delivery sort of businesses like Swiggy and Zomato, who are the two listed players in this space. Investor type 2 are those people who think that this space is getting really crowded and there is no value for money here. Therefore, they are extremely bearish in this particular sector. I do not know which camp you sit in, but by the end of this video, you are going to get 100% clarity on what is happening in this particular space, because I am going to deep dive into Swiggy's business and I will present you some mind-boggling data which will help you understand where is their business going. Let me first set some context for Swiggy's business. Last year in November 2024, Swiggy came out with their IPO, and this IPO was oversubscribed by around 3.59 times. More interestingly, if you look at the qualified institutional buyers, QIBs, they oversubscribed this IPO by almost 6 times. There were only 8 crore shares up for grab, and the bids that they received was 52 crore shares. So there was a huge hype about Swiggy at the time of IPO, so much so that Swiggy got listed at 8% premium over its IPO price. IPO issue price was 390, it got listed at 420 rupees per share. Few weeks after their IPO, this hype continued, so much so if you look at the stock prices, they went up to all-time high of 617 rupees per share. That was almost a 50% gain in the prices. But the big question here is that, was this price hype followed by the fundamentals, business fundamentals? I'm going to help you understand that in a few minutes. But what happened afterwards is what you need to understand. Just before their Q3 2025 results were about to announce, there was a huge profit booking that started. And what happened as soon as the Q3 25 results came out? The stock started to go into downtrend. What really happened here? Why all of a sudden this hype melted down? Let me help you understand with two particular reasons that you need to know. Reason number one is their losses started to widen up. If you look at Q3 25, if you look at Q4 25 results, you will note that operating profit was down 726 crores, 964 crores. More importantly, if you look at the PAT, it was down in Q3 to 799 crores. In Q4 25, these losses went up to 1000 crore. Second key reason was in the month of May 2025, the lock-in period for almost 83% of company's total shareholding expired, meaning that there were a lot of sellers in the market who were willing to offload Swiggy share because the lock-in period that the IPO had, which was for 6 months, it got expired in the month of May 2025. Primarily, these were the two reasons. One is the drop in the fundamentals, and secondly, the supply of the shares in the market started to go up as the lock-in period expired in the month of May 2025. Number one takeaway here is that never get carried away with the IPO hype, because the volatility is very high after IPO especially, and therefore you really need to look at the fundamentals of a particular business. And the second key takeaway here is that never ever invest 100% of your money into stocks, because stocks are hugely volatile. Please make sure you invest 20 to 30% of your portfolio into fixed income instrument, for example corporate bonds, that can give you fixed returns like 9 to 12% on an annual basis. In fact, on my channel I've created these two videos explaining a great deal about corporate bonds. Coming back to Swiggy's fundamentals, the stock's fundamentals are deteriorating. Have a look at my screen and you see the losses for Swiggy in the last 4 quarters have gone up. In Q1 of FY25, they were doing 611 crores of net losses. It has gone up to 1081 crores. Total yearly losses have gone to now 3000 crores. Now Swiggy is not alone in this particular race. If you look at Zomato, you will find very similar trend. Although Zomato is PAT positive at the minute, but if you see, the profits have been declining. For example, if you look at the last 5 quarters for Zomato, the profits have declined from 175 crores to now 39 crores only. So it is not the problem only with Swiggy. Even for Zomato, the profits are declining. That is the trend we are seeing in the last 4 to 5 quarters. Having said this, there are specific problems with Swiggy's business that I want you to understand. If you look at Swiggy's business, they've got 3 main revenue generating businesses. Number 1 is Swiggy food delivery. You and me go and order food from Swiggy. Number 2 is Swiggy Instamart, which is their quick delivery business. And then they have Swiggy Dine Out, which is out of home consumption sort of a business. Now, if you look at the food delivery business of Swiggy, that is fine. It is contribution margin perspective positive. From an EBITDA margin perspective as well, this is positive. Very soon, it is likely to become PAT profitable. I don't have any issues with their food delivery business. But when it comes to their quick commerce business, their Instamart business, have a look at these numbers, and what you note here is that contribution margin percentage is negative. What is contribution margin percentage? That the company is not able to even recover their variable cost. Forget about fixed cost. They are making losses. They are not able to even recover their variable costs, for example, delivery fees, employee expenses, etc. And secondly, if you look at their EBITDA margin percentage, it is down to 18%. So they are making losses at EBITDA level by almost 18%. And if you look at the broader trend in the last 3 quarters, the EBITDA margin percentage have been going up, meaning they have been making huge losses at EBITDA level when it comes to the quick commerce business. And it is a very, very similar trend that we can see in Zomato. For example, if you look at food delivery business of Zomato, you will see that their EBITDA margins are in positive. But if you look at the quick commerce business, in the last 3 quarters, if you see, losses at EBITDA level have gone up. It has gone to 1.9% in Q4 of FY25. And in fact, if I talk about Zomato's business, if you look at the cumulative EBITDA margin, it is only 0.9%. It is not a huge number. They are only shying away from just few percentage to start making losses. Now, why is that Swiggy's quick commerce business is making such huge losses? There are 2 reasons that their management have given. Reason number 1 is that their management is saying is that they have added a lot of stores in the last 2 quarters. If you look at Q4 25, they've ordered 316 stores in just 1 quarter. And if you look at the last few quarters, clearly this quarter stands out in terms of number of stores they have added. And as a result of so many stores being added by Swiggy, the average age of these stores is now less than 4 months. And when a company operates so many new stores, then what happens is their network cost goes out of the control. That is what is happening here. They have a higher underutilized network cost at the minute. Reason number 2 that the management is quoting is the huge competitive intensity in this particular space that is forcing companies like Swiggy to offer a lot of discount on delivery fees and otherwise as well. And if you look at the competition, it's not just from Zomato. There are new players that are entering into this market. For example, Amazon has launched Tez. Flipkart has already launched Minutes. And more importantly, there are 19 quick commerce players that are about to enter in this particular space because of this huge intensity in terms of the competition. And because of this huge competition, Swiggy is offering a lot of discounts, and therefore their profitability right now is taking a big hit. Now comes the natural question that, Rahul, will they continue to make losses in the upcoming quarters, or can they recover from here? So what their management is saying is between December to June of 2026, they are likely to break even at contribution level, meaning that their contribution margin, which is right now running at minus 5.6%, this should become positive 0%. But please understand, this is only first step of achieving profitability. After contribution margin, which is only covering your variable cost, then comes they need to become profitable at operating level, which is EBITDA margin percentage, which is minus 18%. That will be the second step that the company becomes EBITDA positive when it comes to the quick commerce business. And the third and the last stage will be they become net PAT profitable in terms of producing healthy profit, sustainable profit on an ongoing basis. And right now the company is projecting that between December 2025 and June 2026, they should become contribution margin positive. We do not know when the company will become EBITDA margin positive. We do not know when the company will become net PAT profitable. In my view, we are at least 2 to 3 years away for this company to become PAT profitable, even if I take the best case scenario. Now, whenever you analyze a company, please make sure that in addition to profitability, you are also looking at the balance sheet. So for example, if I talk about Swiggy's balance sheet, there are 2 big problems I note right now in terms of the trend. First big problem is that if you look at their cash and cash equivalent, in Q3 FY25, it used to be around 1692 crores. It has come down to almost 1230 crores. If you look at the bank balances other than cash and cash equivalent, that has also come down from 2400 crore to almost 2069 crores. So there is a significant cash burning that the company is doing right now. Where is this cash going right now? If I show you some more data, for example, have a look at my screen and you will see some of these cash burning is happening in the actual losses that the company is booking. For example, if you look at the operating losses, they have gone up from 400 crore to almost 631 crore. So there is a cash burning in terms of the losses. And the second more important cash loss that you're seeing is in the working capital here. In Q3 FY25, it used to be around 349 crore. It has gone 3 times to almost 1114 crores of cash burning in working capital. So these are some of the red flags that I am seeing right now in the balance sheet. Again, I'm not here to tell you how the stock prices will move, whether the stock prices will go up or down. What I'm really sharing is the business direction with you in terms of the profitability direction, in terms of what is really happening in the balance sheet. I want you to understand business fundamentals, because stock prices are not in my hand. Stock prices are not in your hand. Investors all of a sudden might start to accumulate the stock. They might start to dump the stock. We are not worried about the stock prices. First thing we need to do is look at the business fundamentals. And in this video, I have brought you the key insights from their quick delivery business, which is the main drag right now for Swiggy. Can they recover from it? Of course, everything is possible, but the biggest risk for them is the competition, as a lot of big players with heavy balance sheets, clear balance sheets, are entering into this business. It'll be extremely interesting to see and watch how Swiggy from here on takes on their quick commerce business to a profitability path, and also at the same time maintains a healthy balance sheet. Again, I cannot predict that, but hopefully you enjoyed this video. If you like this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Also, you can consider joining my YouTube community, because almost on daily basis I share exclusive in-depth analysis of various assets, and it will help you understand investing in a very practical way. The feedback of this community has been excellent. Go to my channel, find the join button and be my guest. With that, I hope to see you in my next video. Until then, keep rocking.